Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Friday, September 1st, 2023. It's 2:32 p.m. Eastern Time as I'm starting the video, and here's what we'll cover. I'm going to go over the equity markets briefly, Apple, the semis I'll do an update on, and then the other things that I'm watching that I believe are related and will have an impact on which way the market goes from here, and that'll be treasury bonds, or more importantly the yields or the bonds, whatever we want to look at, financials, crude oil, and commodities really, and the euro US dollar, all of those, particularly the euro US dollar, and at this point interest rates as well. And these things are all related to some degree or another anyway. And anyways, let me just go over the levels, get it out to you, because I'll probably cut out early after this. Got some things I want to knock off before the weekend starts, so this will probably be the last update, unless anything crazy happens. All right, start out here with QQQ. Let me roll it and zoom in. There's the downtrend line off the highs. Now I have a couple variations of this downtrend line, both on the NASDAQ 100 ETF, which is QQQ, and the NASDAQ 100 futures. So we'll look at those real quick as well. But as mentioned yesterday, it was an extremely low volume day, low volume breakout, which is a sign of non-confirmation. That doesn't mean it didn't happen. It did happen, but it was that wasn't a very solid close above there. We closed above the line. If you squint and look close enough, the way I have it drawn, again, you close, but not far from an impulsive breakout, which is what you ideally want to see. Now, as I like to say, price comes first and foremost, volume and everything else are distant seconds. And so we're above it. We're above the trend line now, back testing. Pretty good turnaround today. Nothing huge, but from the morning, the highs so far, well, to the lows. We're almost at the lows right now. We're just hair off them. That's about a 1.25% fade of this morning's pop. And so that shows you there's some sellers lurching in the shadows at this level. Wasn't random in my opinion. I'll get to let's just look at, because Apple affects the NASDAQ 100 probably more, well, definitely more so than any other stock. And so far it hit that we're almost there. And again, a lot of eyes are going to be looking at the top of that gap. That was that potential target. If we go past my that's, I list final targets where I think the RR is no longer favorable to be long. That's what a final target is for me. Doesn't mean you can't go past it. Quite often you do reverse on those, but it just means, again, especially initiating a new long is very poor. So there's minimal upside to the gap, and we're close, not all the way there. And as I said, that's where traders usually will start stepping in early. The trend indicators on any time frame you're at, the PPO often acts as a good trend indicator. Look at the signal line, the white line. When it's above, the trend is bullish, and when you cross below, which is right here, all the way to that point there, the trend is bearish. And so, and often when you cross, when the PPO line crosses above or below, the zero line, which is what I was referring to, the dotted line there, of course, above or below that, then it often acts as resistance. So you had a sell signal, at least on that indicator there, and it told you all along here it was bearish, and these two rallies back to the zero line resulted in rejections. They capped that rally there. So just to point that out, we're still below there, and again, after coming off what I believe to be a very powerful sell signal, break of a very long-term uptrend line, big negative divergences, et cetera, et cetera, et cetera. So nothing's changed in my outlook for Apple. My convictions aren't super strong because we are, again, within what I call spitting distance of at least the previous highs in the market. And when we go back to the SPY and QQQ, talking about the July highs, and then we're, of course, a little farther off the highs back from, in the NASDAQ, it was November of 2021. In the S&P, it was right in the beginning of January of 2022. And talking about the high. Now on SPY, let's look at SPY real quick. On SPY, although we did have that unimpulsive breakout above the downtrend line in QQQ, which I thought was a level to watch, on SPY, you still have this uptrend line off the early March lows right here being back tested. So far, this is the third day of back testing that trend line. Another rejection off there. You can see we keep tapping it, And so we'll see what happens. I don't, an hour and a half to go in the trading day. I don't expect a whole lot to happen. I don't think we're going to know a lot more. So even if I were to, be around at the end of the day and do another update, for this to change significantly, we'd have to close like this today and way up here, or solidly above that trend line, and or have a bigger drop towards into the close, and that certainly could help. That would give you that rejection candle off the back test. Remember, this is all so far. That is a potential topping stick. That was a divergent high on the S&P 500 and a big old bearish engulfing candle. That's BEC, and just like you had at the bottom there, that those bullish engulfing candle, also BEC, and a divergent low. So we'll see. It has the potential to be top, but you got to stay below the bearish engulfing candle. So this is, again, I've said it repeatedly recently, this is the area we're really pushing the upper limits of where I think this bounce should go if it's a counter trend rally within a new downtrend with a lot more downside to come, and that's still my preferred scenario. Hard to get too gung-ho bearish on it when, again, you can just pop up there and you're mere percentage points from that previous high and not too far also from the all-time highs right there. So again, to be continued next week. All I can do is give you my thoughts where I think things are going, and also try to give you my convictions, how high or low, and they still remain, in that, favorable, still worth to me, like I said yesterday, even though I won't add to shorts above the downtrend line in QQQ. Like I said, the breakout yesterday and the fact the S&P 500 was testing, you had the Russell 2000 hit that bounce target. A lot of reasons to give it a little more room, in my opinion, as far as a longer term swing position. That was board one. There's the other board right there. And speaking of that, speaking of the small caps, there it is. So that's the breakout I highlighted the wedge before it even broke out, and then it broke out, highlighted right when it broke out, so probably see more upside. Had the arrows going up here. This is a resistance zone from about 1920 and change up to almost about 1930. And so we hit, as I've got out to you today, the upper end of that bounce target zone, which is close to a little shy of the measured target. You take the widest part of the wedge, add that to where it breaks out. That would bring you about right there. So, and close enough to the measured target, and more importantly, right at the top of that resistance zone. If they pop it, my next resistance isn't up until there, and that's going to be most likely coincide with more upside in QQQ and SPY, and not necessarily, but most likely. However, I think this is it, and this is an uptrend line that's now formed right here. You can see nice clean uptrend line, and so if we get a rejection off this resistance and a break of the trend line, then there's a good chance you get some divergence down here as well, that's the end of the run, that's that counter trend bounce, that this was a significant high up here. Remember, this trend line goes back a ways right here. That's the thing, you're coming off much more significant longer term uptrend line breaks in the S&P and NASDAQ 100 and everything else, and big divergent highs. So that again, I always have to repeat myself on this because it bears repeating. I'm sitting here 1 minute talking to you about 5-minute charts, and the next minute I'm talking about weekly charts, and there's a big difference on what my very short-term, near-term, intermediate, and longer-term time frame looks like. But most importantly, I put a bigger weighting on what happens on the longer-term charts. When you finally get a sell signal on a daily chart, or even better on a weekly chart, that supersedes or kind of flips that, puts you into, if it's a sell signal, that is, like these trendline breaks and all that, that puts you in sell the rip mode and tells you can certainly trade the counter trend trades, just they're usually not going to be little divergent lows and bullish falling wedges like this at that point are less likely to be the catalyst to new highs like they are in a bull market or a bull trend. Okay, so hopefully that makes sense. In a bull market, I love to see these 60-minute divergent lows down to support, and those are, again, usually what you want to cover any shorts if you're gaming a pullback trade and get long for the next leg up. So certainly still a possibility. Let me show you one or two other things here I mentioned there's NASDAQ 100. Here's a 15-minute chart. You have another, divergent high, divergent high, divergent high, divergent high. You can see the turns in the market, divergent low, divergent low, divergent low. That's just kind of got lost here. Oh, we had a divergent high that never panned out. That's what that was. So it shows you they don't always work. More often than not they do. But when they don't, and it's kind of like I say, nothing's more bearish than a false breakout. Well, there was a failed bearish development. I expected this to do this, but then Warren, that was a big resistance, and that we hit it, rallied up to it, and then boom, we popped it. And so what happens? Short sellers covered, longs pile in, and that's why you had that impulsive move, because that is one of those things where the technicals are pointing to something going one way, and then they turn around and go the other, and that's where you get your sharp moves from in the market. So that's just a 15-minute chart. If I take it out here to a 6-month chart, which I just did, see, now you can see this trend line is a little bit different. If you step back, here's the downtrend line off the highs. Forget about these DHs and DLs. They're from my 60-minute chart. So just ignore those. That's why you're seeing a lot of them right here. That was a divergent high here on this 120-minute chart. That's what I went to, guys, at 2 hour. So I can go back 6 months in time. And so again, to me, this is bigger picture. That trend line comes off the early March lows. It was very well defined, nice and clean, just like the uptrend line in Apple. We started building divergence at this point, and that's where it started panning out. Then we went and broke very significant support zone, which now becomes resistance. That's about 15,533 right here, and that's the top of it. And that's where we're at. We're right around that level right now, 15,478. And there's the downtrend line. So you see, that's what I wanted to point out here. Even though on my 60-minute charts comes in a little higher, this is how this one's drawn. And I have it on log scaling. If you don't put on log scaling, you're going to get a different, different levels on your trend lines. So that's it. So to me, this is so far, even though QQQ, which is a tracking ETF, but it's just that. It's an ETF that tracks the NASDAQ 100. These are the futures. You're going to have a slight price differential between QQQ is tracking the spot. It should trade right where the actual index is at this point in time. Futures have a premium, a time premium built into them. So they're going to usually trade above the value. So you're going to get slightly different values, hence slightly different trend lines. And that's the reason I'll trade them both, or chart them both, most importantly. Even if I'm only trading one or the other, you want to chart both of them. So that's it. So we're at resistance, both price and downtrend line resistance. And so this is bullish. Next week, if we do this breakout, even not much more, I think that opens a door. If we can take out, let's just say, to be safe, maybe overly simplistic, but if we take out yesterday's highs in QQQ, or did we go higher today? Let me see. Oh yeah, today's high in QQQ, that'd probably do the trick to give us more upside. So if you are looking for a place to go long, add to longs, or set a very tight stop if you're short, I think that would do the trick right now, because we kind of had the little pop that I think will be a failed breakout. And again, it's still, we're at the resistance level on the futures on that 120-minute chart. So I think if we're going to do it, we need to do this. And then these are the big levels, the red, the uptrend line, and then 354.70. That's that Friday, a couple Fridays ago low, 2 weeks ago right there. And then I do what I do. I jump down to the short-term, very short-term charts. This is the world of the active trader, divergent high, trend line break, little wedge, short, and you had a trend line break here, breakout in a back test, go long, divergent high, divergent low, divergent high, divergent low. This is where I mentioned yesterday in the video, and there's where we broke down right before the close. This morning we back tested it, so if you missed that breakdown or didn't want to short it, yesterday because the markets were closed, you had an opportunity today. That's nice. You see a lot of reactions here on this one, and so it's not like we're falling hard, but we are down. And again, the only thing that happened yesterday from where I had this here, we popped up this morning. That's this morning's pop. We popped back into the wedge, then broke down. So what it was, here it is. It's a bunch of whipsaws when you zoom in close. That was the breakdown while I was doing the video. We popped up today, but then they faded it hard, broke down again, and then made the back test. So it's been whippy, that's for sure. All right. But with that being said, we're below the wedge, and we're working our way down. And all longer and even intermediate term trends start with a turn on the smallest of time frames, a 1 minute, 5 minute chart. So we'll see. Only time will tell. I'll turn off all the lines. We know that going back into the beginning of the year, we know this has been the intermediate or longer term, if you want to frame it from that time perspective, trend. Then we've been in a downtrend so far since that peak. So far we have, as you can see here, lower highs. And again, so when we start going up next week, you're going to have taken out these previous highs there. Then you only have that one left to go, at least in QQQ. So that would be bullish. And if you start to move lower now, take out, especially this low, that's again what I've been harping on now for 2 weeks. Since we put it in, that was that Friday's low. Well, different boards there. Wrong time frame. Daily chart. There it is. 354.70. Okay, so I already showed you Apple. Let's go to SOXX because that's probably the closest related sector to the NASDAQ 100 other than XLK. XLK is the tech sector. SOXX semiconductor sector. I've got different boards here. Let's see which one I want to show you. Which one's clean? Let's just start with, well, there's a nice clean uptrend line. You want to know the lights out level for SOXX. There's your primary uptrend line off the October lows right there. Set an alert on that one if you don't have it. Just nice and simple. Use log scaling. Boom, 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 boom. And then my more busier board, if you recall back here, I stated on the site in response first to a member asking the question because we were short the semis. Do you think they'll? Yeah, I said yes. I think they'll bounce. I covered mine. Came a bounce, and that bounce target was up to right here, 509.48, and we're just like QQQ, a hair above it. So again, it's not a, to add now is just speculating, and it might work that we're going to fall back below it next week. But the safe bet, of course, is to wait for a failure back below there, and then much even safer if you want to wait for a conventional sell signals, wait for a break of that trend line. That's the same one I just highlighted for you there. So like QQQ, we put in a divergent high. Big negative divergences. Like QQQ, should we go up, and it's not a whole lot in percentage terms, and I can easily see it. It's not my preferred. It's my alternative, but it's still a longer-term bearish scenario. Again, anything else, meaning we go up 10, 15, 20% or a lot more, 30% new bull market keeps running, then I'm just dead wrong. But as of now, my alternative scenario, which is still a bearish scenario, has just a marginal, ever so slightly, maybe a few percentage points over that high. The semis, it could be 3, 5, 6, 7, and 8%, probably no more than that. And then just like QQQ, if you get it, you're guaranteed, if you get it soon, to have negative divergence. That's why I think, be very clear what I'm saying. The RR, risk reward for a longer term investor. No, we don't have the sell signals yet, but I just think that any upside is most likely minimal in tech and the semis. Like I said, from here, maybe 7-8% or something like that. And again, we could certainly go up more. And if you disagree with me, then fine. Just set some stops, or more importantly, watch out for a false breakout. If you pop the new highs and then you fall back below that previous high, and especially if you fall below that trend line, then that's where you might want to, I would certainly consider either getting out of those longs and or reversing into shorts for a much bigger drop. I'll just touch on financials because I did a video. It's pretty much a non-event today. The sector itself, XLF, is up, but nothing big, 0.81%. BKX is up about 1%. Still potential flagging action there. And again, the banking sector is much closer to multi-year lows than it is multi-year highs. This is just the area of the Magnificent Seven, the big tech stocks, and it's pulled the indexes up. Remember, QQQ is simply a reflection of those Magnificent Seven. They make up over 50% of the returns of the NASDAQ 100. So, again, that's why QQQ is closer to its 52-week highs. But this tells you something. It tells you something about the economy. Now, the bank stocks, if they want to giddy up and start participating, sure. Then we could be looking at, another 6 months to a year or years plus of gains. But as of now, again, they're precariously close to their making new multi-week lows. And I already gave you the levels to watch, and there's no big change today. JP Morgan still below trend, so there's no technical change here. It broke down. It's just consolidating in this little area here. And at this point, we just need to take out those recent lows. You can see we've had a couple checks here and around 145.50. And again, the farther you get away from this trend line, you had the impulsive rejection so far, the more it's going to firm up that bearish case. And then my lights out level right there at about 140, 385, if that's solidly taken out. And then the 200 days, everything I covered yesterday. Let's not duplicate that. Let's just say there's really no change in the outlook right now. Okay, so that's let's still look at treasuries. Remember, oh gosh, it's been probably close to a year now. I started laying out and posting on the site. I had a little drawing thing I made up and talking about the negative feedback loop between the stock market, stock prices, major stock indexes, inflation, and interest rates, because that's kind of what's there. So we're seeing it lately. This is I've covered this many times. This was the cause, big, or if not all of it, that's what was attributed to the recent drop or the peak in the stock market so far. And the treasury bonds, they certainly could pop here. Let's look at yields. Let's flip it over. But IEF, if you're looking at the 10-year treasury ETF, there's a downtrend line to watch. And let's see, I had it. Yeah, because I gave it to you as a trade idea here off the divergent low. But we're at downtrend line resistance. So, you're still coming off a divergent low. It has the potential to do this. And this would most likely coincide with that pop in the stock market that runs at test and maybe even and probably takes out the old highs if we see this. However, there is another a variation or version of this. You could still see this, except it coincides, it's the exact opposite. Instead of stock market going up, it coincides with the stock market falling, but falling pretty hard because of that flight to safety. So if all of a sudden something rattles the financial markets, institutional investors are going to move money into treasury bonds and they're going to sell stocks. So that would be that scenario. So watch it. It's yeah, that is what it is. So in other words, you have the levels to watch, and just understand if yields start going up or down. Most important to know is to know why they're doing it, and then what impact that might have on the market. Sorry, just hit a couple buttons there on my keyboard and something wonky happened. Hopefully the video still recording, everything's working out fine. All right, so TNX, that's the yield on the 10-year, probably the most important if you're only going to watch one. There's still a very significant long-term uptrend line this thing's flirting with here. I could probably pull that down there. I'll just leave it where I had it. It's give or take. And so, if you just turn all the lines off and keep it very simple, you have that long-term, uptrend line goes back to the COVID lows. And then you have the 10-year pushing on highs. These are levels right here. We saw it back at the end of last fall, or almost this time last year. And then before that, you have to go all the way back to 2007. I need to go to a weekly chart to do that. So this is, can't say it enough. This will have almost certainly a direct impact, a negative impact on the stock market. Whereas this, unless it's coinciding with a sharp drop in the stock market, will most likely have a positive effect on the market, because yields are falling, and that should be bullish for equities. So continue to watch those. I do keep an eye on junk bonds all the time, and corporate bonds, JNK, look at LQD, the corporate bonds, and I'm looking for changes, uptick in credit spreads. That's a differential between what junk bonds and treasury bonds are paying, things like that. And I'll continue to monitor that. And then there's the commodities trade. So you have USO, crude oil, and this one, make no mistake about it, you can look at just crude oil. Crude has the biggest impact of all commodities, or you can look at one of my proxies like DJP, Commodity Track and ETN, and make no mistake about it, especially lately. This is where I originally came up with that, that vicious cycle of commodity prices, which lead to higher inflation, which then cause the Fed to continue to tighten. And if we go here and you just overlay, you can do QQQ or SPY, you can see that the market is very sensitive to changes in commodity prices. Every time they start to drop, you get the market rallying. But more so lately, when you look at this, You can see you get these spikes up, and it takes a while, but once the market gets a message like, whoa, this could have been the start of a new uptrend. Well, it was actually. Then you get a little pullback there. Commodity prices fall. Oh, okay, we're good. Inflation's over. The Fed did win the battle. But no, another leg up in commodities, a bigger drop in the stock market. Okay, so nothing goes straight up, but you can see what I'm drawing here. I'm drawing what appears to be a stair step up. I think we told you that in the past. I think this was a big correction on early stage bull market action in commodities. And so at this point, again, just like watching treasuries and the euro, which I'm about to get to, and the dollar, if we go on here, you take out that previous high, the market should take note of that, because now it's going to start, the longer this occurs, higher highs and higher lows, in other words, an uptrend and higher commodity prices, crude oil, natural gas, food, grains and live cattle, all that stuff, then that's going to most likely put additional pressure. And at some point, the headlines start to read, okay, inflation's back, the Fed's job's not over yet. That's going to be dangerous for the markets. And so watch that. Just keep an eye on it. You can watch, like I said, DJP, or one of the broad-based commodity ETFs, crude oil. Crude oil has a bigger impact. You can watch natural gas too. Really no updates on those. Natural gas still basing. Last but not least, the dollar, or you can look at the euro-US dollar pair. Remember that rally today got faded in the stock market. By no mere coincidence, this is the euro today. If you look down here, this is when the market opened. I'm going to draw it. This is 9:30 a.m. right here. So the market gapped up, popped up, and so, for those of you that, I've highlighted 1,001 times already. There is that direct correlation with the euro-US dollar pair and the stock market. So so far, the euro just can't catch a bid. It keeps putting in this divergent low. Maybe it'll play out sooner or later. But so far, every time we've start to rally off a divergent low, it gets sold into. And when you look at, that's the longer-term chart. Remember, this was bigger picture. This was the daily chart, put in a big divergent high here, and then you broke the primary uptrend line right there. And that's it. You had a counter trend rally, stopped at resistance. So now basically, if it breaks these recent lows about 107.633, that could open the door, likely would open the door to another leg down. And then on the weekly, it's a big bearish rising wedge that just broke down and hasn't looked back. Nothing but red sticks since, even especially off that divergent high. These are weekly candlesticks, negative divergence. Or you can flip it around, look at the US dollar. You can use UUP, the dollar ETF, and you can see the dollar had nice resistance right here. You can see that was peak, and it broke out recently. So it has some divergence. Maybe the breakout will fail, but as I like to say, a breakout is a breakout until unless fails. Resistance is resistance until unless taken out, and it was taken out. And once resistance is taken out, it then becomes support. So we've been back testing. So bearish for the stock market, bullish for the stock market. Simple as that, right? You can, again, just turn off all the lines and look and see what the impact here compared to a QQQ. Even better, SPY, but I'm just using QQQ. Now you might say, Randy, I don't see it there. Well, let's do this. Let's go to UDN, which is the inverse dollar. That's why I use that euro chart. That's turning the dollar upside down. And there you see now the clear correlation where they go up and down together. Simple stuff. So those are the things to keep an eye on. Every now and then there are periods of disconnects. Those periods of disconnects usually result in a mean reversion. In this case, the dollar, that was a sharp drop in the dollar, and it caught back up, but then the correlation has returned, and we're seeing that divergence again. This is the stock market rallying. This is QQQ rallying, and the dollar started to go and said, okay, yeah, let's go, let's rally, and then the dollar changed its mind. The dollar is going up, and again, this is UDN, the inverse. So that's it. Those are the things to watch, and I'll give you one more kind of a random trade idea if this bullish scenario plays out, even if it's just marginal new highs or more. Let me turn off this. Intel is catching my eye. Intel, We've had some really good trades on this one, trading off this divergent low early in the year, going back and forth, getting long, couple even some short trades off the top. But what I've been pointing out, I'm going to tweak my trend line right now. I'm going to tweak it because I was a little shy under right there. I was cutting the top of those candles off. So we're coming up to major downtrend line resistance. This is the bear market downtrend line for Intel, and we have negative divergence. So we're in a bear market. That's probably a good time to short it. However, if it breaks out, that's going to be bullish unless the sector rolls over. And I already covered the semis in here earlier, so we're at resistance on the semis. So I think the odds favor this. You could take a shot on Intel. I'd have to look at the 60-minute chart. Yeah, you've got some divergence going on here. I don't know. I don't have a position in it, but next week I'll revisit it, and maybe consider adding that one as an individual short. My preference usually, this guy's beat down. There's more meat on the bone for things like Nvidia and some of the other semis once they crack. You've got which one is it? Broadcom, I think, coming up to report soon. Nvidia with that big divergent high. Broadcom's reporting on September 7th. You've got big divergence on that one as well. So things like this, in my opinion, have a lot more meat on the bone on the downside. But I did want to point Intel out, whether you're bullish or bearish on it, or you're looking for a trade idea. Point out that trend line. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great weekend.